Hey, finance fam, welcome back to my channel. There's been a lot going on in the financial markets, so I figured I'd do a video kind of going over what the action has been in stocks and in Bitcoin, and also talk about what I'm looking at in terms of economic data, where we might be heading from here, how I'm approaching investing, etc., in a very, very confusing time. Let's kick it off with the S&P 500 chart. The S&P 500 has essentially been selling off since July 2023, and we've been in a very, very clear downtrend since then. The big area that we were watching was this 4,200 resistance turn support level, which we ended up breaking down through 4,200, and we are now continuing the downtrend below the very, very important 200-day moving average, which is the blue line. The 200-day moving average is often going to kind of guide price. You can see that price likes to pivot off of it. This is back in 2022, August 22, where price basically pivoted right off of it. We had some consolidation and some choppiness kind of around the zone. And then you can see that in 2021, price was so strong that we didn't even retest the 200-day moving average, which was pretty wild, but the strength was just extraordinary. And you can see historically that price has reacted off of the 200-day moving average by using it as basically support and bouncing off of it, or using it as resistance. So we were watching 4,200 because everything was kind of lining up here, but not looking too great. The weakness has settled into price action, and we're looking to see if this is going to continue lower, possibly to retest the 4,050 zone. With all of that said, I don't think that this sell-off in the S&P 500 is a bad thing. Valuations were actually not really getting people very excited about throwing money into the market. And so I think that a little bit of a cool down in valuation is actually a good thing for investors. And we'll get to that shortly. I can't say that this sell-off is a surprise to me, like I said, because of valuation. But if we actually look at how much the S&P 500 is up year to date, you can see that we're still up. Even after this sell-off, we're still up almost 8% for the simple fact that we did have a big run coming from the pivot low here in October of 2022. This was a pretty significant run that the S&P 500 had. So, cooling off a little bit is not the end of the world, and the stock market is actually still up year to date. Now, this is a really big week actually for the stock market, measured by either the Nasdaq or the S&P 500, however you want to look at it. A lot of these big names are in both indices, but we have basically big tech earnings that have been coming out over the past few days. We've heard from Microsoft, Alphabet, aka Google. We heard from Meta, prior name Facebook. So we are hearing from Amazon today after the stock market closes. And we've heard from many, many other names in different sectors of the market. So what we kind of have gathered so far is that there has been some good and there's been some bad. There's been some lukewarm. It's been, a very mixed picture. For example, Microsoft and Google's earnings were actually not bad. They're still growing double digits in terms of revenue growth. And then, Meta had a pretty blowout quarter where they had over 20% revenue growth for the quarter year over year. But guidance, meaning the expected future earnings and revenue, didn't really excite investors too much. And basically, it sounds like they are unsure about how the rest of the year is going to go. So obviously, investors hate uncertainty. So that didn't help matters. So it has been quite a mixed picture. Revenue trends have been pretty good for these companies, but maybe management just isn't sounding very confident in how things are going to look going forward. This leads us to valuation of the S&P 500. Everything comes back to valuation. That's how I personally gauge, when to put the pedal on the gas and buy more stocks that are at a better value, and when I put on the brake or try to sell some things to kind of harvest cash while things look expensive and take profit. So valuation is really the crux of investing. Even if you're a passive ETF investor, it's nice to kind of pay attention to when the market is showing value. You can see here that every single year this is tracking what the earnings were for the S&P 500 for that year. So in 2022, we had $218.09 earnings per share for the S&P 500. That grew or is expected to grow slightly to 219 for 2023, but we don't know what that exact number is going to be. This is an estimate so far with what we know. Then for 2024, analysts are estimating that we're going to see 12% earnings growth for the S&P 500, which is quite extraordinary considering the circumstances, considering the uncertainty, and really what we think is going to happen is these earnings estimates are going to have to come way down, or they're likely to come way down unless something really turns in the economy with the consumer and things just boom like they expect it to. But we think that the more likely scenario is we will see growth in 2024, but it won't be as great of growth as being estimated at the moment. So, making this make sense for your sake, let's give it a visual. The price to earnings ratio right now, we're trading somewhere around 17 times price to earnings based on the next years of earnings expected. So, that is lower than where we've been trading. We can see that we have been trading much higher in the 20s. We've also traded as low as 10 times earnings, back in the 2008 financial crisis. And more recently, we have seen the 13, 14, 15 range as well. So that kind of gives you some perspective as to how we are trading right now in terms of valuation in the S&P 500. We're not expensive, but we're also not cheap. We're just kind of right there in that Goldilocks zone that isn't terrible considering the fact that we're still expected to grow in 2024. So really, if the S&P 500 price ends up going lower, I think that we're just going to have a more compelling case to continue to buy stocks and just trying to take advantage of the corrections because we have to remember that market corrections are investing in wealth growing opportunities. Something interesting that happened is Bitcoin had a run and it's actually up 100% year to date, which is wild if you think about it. It did have a big drawdown from the highs, but still, it is quite impressive the moves that Bitcoin has. But Bitcoin hit 35,000 for the first time since 2022, basically on the optimism that we're going to see a Bitcoin spot ETF. And so you might be wondering, why is a Bitcoin ETF so important? Well, a Bitcoin ETF is going to allow a lot of people to get much easier access to a Bitcoin allocation. Right now, going through the process of opening a Coinbase account or an account wherever you can buy Bitcoin, buying the Bitcoin, right? Transferring the money, buy the Bitcoin, then you have to, if you want to do it right, pull the Bitcoin off of the exchange and self custody it onto a hardware wallet for max safety so that you don't run into any issues. And a lot of people don't want to do that. They feel afraid to do that. They don't want to mess it up. They don't know how to do it. It feels overwhelming. And that is the majority of the population. The people that are doing it have already studied it and understand this industry and this market very well. So we have to keep in mind that a Bitcoin ETF will really just make things a lot easier because anybody will be able to go to their brokerage account and buy the ETF in the same way that you buy any other ETF. So it's definitely something that people are excited about. And obviously, it might not be fully priced into Bitcoin's price right now after what we saw price do recently on the rumor that this is going to happen. So, as far as the economy goes, things are still very muddled. We are still kind of seeing some good things coming out of the economic data and some not so good things coming out of the economic data. So, why don't we take a look at the things that I'm going to be paying close attention to going forward? First is retail sales. So, retail sales basically tell us, what is the consumer spending money on if the consumer is spending money on anything at all. And so I like paying attention to this. And you can see that during recessions, the 2008 financial crisis in 2020, that we see a big drop in retail sales, meaning people don't spend money or they don't spend as much money. We have noticed that that has kind of normalized. We're finally, after seeing a huge increase in retail sales after people weren't spending money, so they were saving a ton of money, and instead of traveling, they were buying goods. They were out, just spending like it was 1999, right? And so that has normalized. It's come back down quite a bit after quite a roller coaster of ups and downs in retail sales. And so I really don't see the retail sales data as being bad. It's also not like absolutely amazing, but it's pretty impressive considering the fact that a lot of people have spent down their savings from the past few years, their excess savings. So I would say that retail sales look good. Could they deteriorate quickly if things turn in the economy? Yes, but they're not turning yet. In fact, it's just continuing to kind of normalize. The next thing that I'm going to be watching is the unemployment rate. And the unemployment rate is still historically low, even though we've seen a slight uptick recently. We are seeing more people come into the labor force, and we are still seeing this be a historically low number. In fact, we have to go back to um, 1969 to kind of see a similar number here. So I would say that the labor market is continuing to show strength. It's continuing to prove itself that people have jobs. And if people have jobs, it's kind of hard to go into a recession if people are employed. When people start to lose their jobs, that's when the whole thing just kind of crumbles beneath us. So really, all eyes are on unemployment. It is the floor that is keeping everything up. The other thing that I'm watching is, of course, the inflation rate. Now, we've seen a big spike in inflation in, 2022, basically 21, 22. But we've seen this before historically. In the 40s, we saw a big inflation spike. In the 70s, we saw a big inflation spike. So it's kind of funny because the baby boomers are probably laughing at all of us as they think back on when they experienced inflation and high mortgage rates. But of course, things were probably a lot cheaper and maybe it was a little bit easier to handle than it is now. Needless to say, we are seeing inflation cool. We're seeing it come down significantly, which is a good thing. And this is expected to continue to fall by the simple fact that the shelter component, meaning owner's equivalent rent, basically housing, is supposed to help this kind of continue to fall as we've seen housing prices fall a little bit in certain areas and rents coming down in certain areas as well. The next thing I'm watching is delinquencies. So basically, how late are people becoming on their debt payments? And you can see that before 2020, it was a lot higher than what it is now. So even recently, with student loan payments starting back up and all of the doom and gloom that's been in the news, really, we are seeing delinquencies tick up, but they're still lower than pre 2020 levels. In fact, quite a bit lower. So we're watching this very closely to see this has a lot of room to go to normalize. So I wouldn't be surprised to, see more delinquencies, but it might not necessarily be super alarming yet, because again, everything is normalizing, right? We were much higher before everything happened in 2020. So we have some room to go there. And I did want to share in the Daily Doe newsletter, which if you're not subscribed, go to dailydoe.co and subscribe. Travis wrote an article on what the banks are saying about the economy because we did get bank earnings. And bank CEOs had a lot of insights. So let's just pull out a few of these quotes. Citigroup said, and we are seeing some cracks in the lower FICO score customers. So lower credit quality customers, they're starting to see some cracks in that customer spending or maybe in the delinquency rates. Bank of America said, we see that in our customer data, our 37 million checking customers, we see their spending slowing down. JP Morgan said cash buffers continue to normalize to pre pandemic levels. Again, back to that normalized word, with lower income groups normalizing faster. So, basically, what we can infer from all of this is we are still normalizing in a lot of different metrics. We are seeing the lower credit quality consumer, the lower income consumer start to spend down more of their savings and kind of get back to those pre pandemic levels, right? So we know that that is happening. We also know that higher interest rates are a boon for savers. So there's that good and that bad. I personally think that if the consumer isn't careful here, they are kind of walking a fine line as savings buffers go back to pre pandemic levels and back to normal, so to speak. I don't think going back to normal is a bad thing, but it is if inflation is still continuing to roar. So, really, we are counting on A, the unemployment rate staying low, B, inflation coming down in those really, really important categories, especially food and gas, right? So, if those things happen, and rent, but if those things happen, then I think that we could continue to slog along and be okay. It's not going to be super exciting of an economy, but it's just going to kind of be a Goldilocks. We're getting through, we're slogging through. I call it the slog economy. And so that is a very likely scenario in that case where things could get really rough for the economy and where consumers can really crack is if they don't pull back and remember what life was like prior to 2020. Savings buffers did increase, stimulus money was there, and consumers kind of have gotten used to that. They got used to not paying their student loan payments. And so there were a lot of things that happened that I think could have trained the consumer to maybe be a little bit more carefree. So I think that it's time for consumers to kind of take a look, do your inventory of your finances, make sure you're not living beyond your means, and don't walk that tightrope to where you end up falling off. But the data is okay. Like the data is not cracking. GDP numbers are still healthy and expected to be healthy in 2024. Earnings estimates for the S&P 500, aka the stock market, are looking way better for 2024 than for 2023. So there are a lot of things to look forward to, and I think if the stock market continues this sell off, it's only going to be a buying opportunity. So that's the update. That's what I'm watching. That's my take on everything. If you found this helpful, be sure to like and subscribe to my channel, please. Go to dailydoe.co and sign up for our free investing newsletter, and also check out Koifin. That's what I use today for stock market research and charts. You can get 10% off. Use my link in the description below and get signed up so you can start getting on top of this data. I'll see you next time, finance fam.